Over the last 18 months, a number of Indian companies have accessed the capital markets via the IPO route. In fact, the year 2021 witnessed an IPO every 3 days, which together accounted for over 1.3 lakh crores in funds mobilized. Incidentally, 2022, in spite of all its troubles, has managed to keep the momentum going, with 53 companies raising over 45,000 crores in capital until the mid of June. Of course, the last 2 to 3 years have seen some big tailwinds, with many tech startups, e-commerce companies and SMEs going public, a growing interest from retail investors, and the emergence and expansion of fintechs, which are looking to make it a lot easier for everyone to invest. As a result, we saw a massive oversubscription in many recent IPOs, with most of them showing handsome listing gains. Point blank, subscribing to an IPO, as the Led Zeppelin song goes, was considered the stairway to financial heaven. But for everything that goes up, it took these last 6 months for a lot of it to come crashing down, as the BSE IPO index lost 1/3 of its value in this short period of time. But this video is not really about valuing IPOs. Instead, what we have is a compilation of the most common mistakes that investors make when using an IPO for wealth generation, and how some simple tweaks and strategies can go a long way in improving your profits and minimizing your losses in this endeavor. Let's begin. The secret to identifying a good IPO is to back it up with good research. Now, people generally do some research, but honestly, reading a curated article in a business newspaper or watching some YouTube videos is not what I can qualify as adequate preparation. So here's what we propose you do when you next come across a potential IPO to invest into. Number one, start with an evaluation of the business model, and if you can't write down what the company does and how it will continually make money in a single paragraph, then you might have already arrived at a red flag. Next comes in the company's offerings and who is their immediate and potential target market. Then is an evaluation of how big the industry is, who the biggest players are, and what are the growth runways available to the company and the sector at large. Now, this is also the stage where you would want to do a like-to-like comparison of operating margins, cost structures, profits, and even economic moats to judge where this IPO-bound company is likely to stack up against others. Point 4 is for the investor to have an assessment of the company's past and current financials, which includes areas like its long-term debt, working capital requirements, any contingent liabilities it has like pending cases, etc. A lot of this will be available in the draft red herring prospectus, which the company needs to file with the Securities and Exchange Board of India. Yet another crucial area is the experience and stability of the promoters and the management team, and very clearly one should avoid companies with inexperienced managements or promoters with low moral fiber. And finally, always have a check on the risk factors. Now, in my opinion, an IPO is the most riskiest of times when investing in a public company, and that's because there is every likelihood that your assumptions surrounding the business operations or financials might be completely off target, and there is no past record or evidence of how and if the management will be able to increase shareholder value. So remember, if you are investing in an IPO without researching, you are for all practical purposes gambling with your money. The valuation of an IPO is perhaps the most critical of all quantitative parameters, and in today's day and age, this becomes all the more important as we see a lot more non-profitable technology-enabled companies accessing the capital markets. I mean, up until recently, SEBI regulations permitted only profit-making companies with a pre-tax annual profit of at least 15 crores to list in the Indian stock exchanges, which essentially removed most, if not all, tech startups from listing in India. But then in the year 2020, SEBI made some changes in its approach, paving the way for loss-making companies to list in India, with the caveat that institutional investors need to hold 75% of the shares. While this opened the doors for Paytm, Zomato, and others, it does complicate matters from an investor's perspective, as now one cannot rely on the trusted PE and PB ratios. Further, one has to account for the fact that most of these new age technology companies don't have many listed peers which can act as a proxy for performance. As a result, there has to be more reliance on unsubstantiated growth projections, using a discounted cash flow with a higher discount rate, market trends, burn rates, regulatory landscape, etc. In our opinion, an investor's valuation and therefore his or her conviction becomes all the more important because until the stock starts trading, there is no actual price discovery. Meaning everything until then is an estimate on an Excel sheet which is driven by PE firms and venture capitalists who understandably have their own self-interest at play. So do your own research and always keep your eye on the valuations. The biggest storyline driving IPO investing are the quick returns one can make on listing day. And yes, while there are many examples of stock prices rising, we have also seen many stocks declining in value on listing day. If you look closely, stock prices get spiked and corrected many times on listing day, which opens up a matter of timing and luck for the offloading investor. Further, and especially in cases where the IPO has not been oversubscribed by much, it seems everyone has the same idea of selling on that first day, which ends up driving down the stock price much below the IPO price levels. The point remains, if you are investing through an IPO with the sole purpose of trying your luck on the listing day, then you are really not investing but merely speculating. Another mistake many IPO investors make is to pay too much attention to the grey markets. So the grey market is an unofficial stock market where investors trade in the shares of unlisted companies, that is before these shares get officially launched in a stock exchange. And yes, while the grey market does help in gauging investor interest and in estimating the IPO listing price in some cases, one should also note that these markets are unregulated, have zero rules, and are open to serious manipulation. We often see dealings happening in cash and on a personal basis, which means the quoted price can be unreliable and unpredictable. To put it simply, avoid basing your IPO decisions on grey market prices, as these proxies have let down investors many times in the past. Just because all your friends are talking about it does not make an IPO an attractive one. And to prove this point, we even did a satirical video on how one can earn 1 lakh rupees in 15 days, where we showed how random information emanates from unverified and shoddy sources and how this information gets dressed up to look more accurate and trustworthy. In our opinion, IPOs too have this tendency of being washed up with promoters, underwriters, and investment bankers creating positive vibes to ensure oversubscription of the issue. This is done via roadshows, advertising, news features, Twitter, etc. And since there is nothing wrong in marketing or hyping up a proposal, it comes down to the investor to not get influenced by this marketing push and to base one's decision on more qualitative and quantitative parameters. Additionally, it is important that investors also keep a track of the prevailing tailwinds accompanying an IPO. For instance, a bull market is generally when most IPOs are launched. It is also the time when many IPOs are oversubscribed, which generally has nothing to do with the company's business model or growth prospects and has more to do with the optimistic external environment that drives up the price. Now, thankfully, the antidote for these biases is in your control, and there are just 3 parts to it: a clear understanding of your financial goals, the research that you put in, and of course, your risk tolerance levels. And if asset allocation, goal setting, and rebalancing doesn't come easily to you, or you don't have the time to manage your own capital, then do explore ET Money Genius portfolios that help you achieve higher than benchmark returns at acceptable levels of risk and with better downside protection. Yet another common mistake made by IPO investors is to pay higher attention to the subscription data in spite of it being prone to manipulation. So here's what happens. News flows in that just before the IPO, some marquee big shot investor has put in a few crores and that many HNIs are investing in the grey market. To bring more legitimacy, news also trickles in that the world's biggest pension and sovereign funds are showing interest in the issue. This play is called the subscription hype, and for retail investors, these act as clues that the biggest players in the game are interested in this company, however inadequate and rumor filled it might be. Of course, we still don't know if any of these players actually bought or at what price these investors are buying in or what their intentions are post the IPO. So while you can take some clues from the subscription data, never make it the basis for your decision to invest in an IPO. So to sum up, here are the 6 mistakes that most IPO investors make. 1. There isn't an adequate amount of research that is done before listing. Secondly, there is a tendency to ignore valuations. Next, the focus is almost on listing gains, which frankly has nothing but gambling odds. Number 4, there is always that grey market bias, irrespective of the fact of it being unregulated, non-transparent, and manipulative. Point 5, IPOs are always hyped up and retail investors often fall for marketing maneuvers. And finally, basing decisions on the subscription data is definitely on the road to investing peril. So here's what you should do. Firstly, understand why you want to invest in that company's IPO, and if you can't arrive at a logical conclusion, then explore delaying investing in it until there is more information and better price discovery. Secondly, always start by researching the company, a lot like when you would be purchasing a laptop or a DSLR camera. And finally, treat an IPO investment in line with your overall portfolio, which essentially means you should determine your goals, your investment horizon, and your risk appetite. And with this, we come to the end of this video. I sincerely hope this checklist will help you see IPOs for what they actually are rather than what you hope they will be. In my opinion, investing in IPOs carries a high amount of risk than regular investing, and therefore one needs to be even more cautious and selective in committing any capital towards the same. If you found this video useful, then do tap on to the like button, subscribe to our channel, and share this video with your friends. Thank you for your time, and I look forward to catching up with you next week on another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.